Kia ora, and welcome to Monday's Economy Watch, where we follow the economic events and trends that affect Aotearoa. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news that Fed boss Powell gave a hint at Jackson Hole that weaker American labour market conditions may trump inflation risks when they next meet in 3 weeks, and a rate cut is a live possibility. Before that, Thursday New Zealand time, the market darling Nvidia is set to report its results, and any variation from what is expected to be a stellar result or any slackening of their outlook indications could very well have ripple effects on how investors judge their overall sky-high current valuations across the whole equities landscape. It's a huge immediate risk point. But this coming week, we will be focusing on the New Zealand employment indicators for July to be released later in the week. And later today, the RBNZ will update its dashboard to June, so we can see the market winners and losers in the banking sector. Across the ditch, all eyes will be on July's monthly CPI data to be released on Wednesday. And China will be releasing its August PMIs this week. India will update its second quarter GDP and its July industrial production data. And Canada will also have a second quarter GDP update too. But we shouldn't forget that the Northern Hemisphere has been getting in the last of its summer vacations recently. This is the final week before the US Labor Day national holiday on September the 1st, the traditional end of their summer holiday period, and when their financial markets build back up to full strength. They'll be coming back after digesting the Fed's latest indication from Powell's Jackson Hole speech. He noted the core US economy has weathered the, quote, sweeping changes in the US policy, unquote, well, and now says, quote, the balance of risks appears to be shifting, unquote, to the negative side. Markets have taken this as a hint a rate cut could be coming as early as their mid-September meeting. The US equity markets roared back to post a record high on Friday. The US dollar fell and benchmark bond yields retreated. However, in the euphoria of the possibility of a rate cut, markets seem to be ignoring this part. Quote, inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses, unquote. But the markets are betting, on a transitory inflation story again. Inflation embedded for 4 years, induced by tariffs, will be ignored at their peril. Across the border, Canadian retail sales in June were 6.5% higher than a year ago, the best rise since the pandemic recovery in 2022. But some of this is just higher prices flowing through from their tariff dispute with the US, and a small correction dip is expected in the July data. And the Canadians are not ignoring the inflation risks of tariffs. To keep a lid on these inflationary effects of that dispute, Canada said it'll roll back some of its retaliatory tariffs on the US. But the US isn't doing the same, so their consumers will still pay the extra on imports. Across the Pacific, China reported more ugly foreign direct investment data over the weekend. While it didn't actually shrink like it did in April and June, it is running 13% below year-ago levels, and it is still less than half the July year-to-date levels of 2022 or 2023, and down 7.3% from last year. The June to July gain this year, while welcome, isn't anything more than a statistical blip in the context of the fall away over the past 4 years. So it is no surprise that Beijing is reorienting to a focus on internal consumption, something they have a chance of still controlling. The international trade environment isn't moving in their favour, and even when they do still get gains, they're not enough to move their needle. And there was a surprising dip in Japanese inflation in July. It eased to 3.1% from 3.3% in the previous month, the lowest reading since November 2024. Helping was that electricity prices fell for the first time since April 2024. But food prices jumped 7.6%, the most since February. Again, rice was the big culprit. New data out from the Australian Statistics Bureau shows their R&D investment grew by 18% to $24 billion in the 2023-24 year. The strongest growth was in IT, including spending on AI, which grew by 142% since the 21-22 year. The US Treasury 10-year yield is now at 4.26%, essentially unchanged from Saturday at this time, down 6 basis points for the week. And Wall Street roared back on Friday with the S&P 500 up 1.5% after the Powell hint of a rate cut next month. That means it's able to claim a 0.4% advance for the week, which pushed it to a new record high. And the price of gold will start today at $3,370 an ounce. That's down $1 from Saturday, up $36 for the week. And American oil prices have held at just under $64 a barrel, while the international Brent price is now just under $68 a barrel. These levels are more than $1 higher than a week ago. And the Kiwi dollar is now just on 58.7 US cents and unchanged from Saturday at this time. Against the Aussie, we're also holding at 90.4 Australian cents. Against the euro, we're unchanged too at 50.1 euro cents. That all means our trade-weighted index starts today at just under 66.3, unchanged from Saturday, but down 60 basis points for the week. And the Bitcoin price starts at $114,366 and down 2.2% from Saturday. Volatility over the past 24 hours has been very low, at just under 0.6%. And finally, in Australia, AML regulator Austrac has directed Binance to appoint an external auditor after identifying serious concerns with the crypto exchange's anti-money laundering and counter-terrorism financing controls. You can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.